Hello, my name is Alan Panter. I'm a principal at Yeo and Yeo CPAs based in the Auburn Hills office. I am a certified public accountant and a certified government financial manager. I have been providing services, mainly audits, to governmental units such as libraries for over 30 years. Our firm was contracted with by the Library of Michigan in 2019 to revise the Public Library Financial Management Guide and also to create these short webinars that cover a variety of library accounting topics. This short webinar is going to discuss internal controls. What are they and why do we need them? This webinar is designed to give you a basic understanding of internal controls and why they are important, the inherent limitations of internal controls, what are some common indicators of potential fraud or embezzlement, and some examples of internal control policies that all libraries should have. So let's dig in. What exactly are internal controls? This is a term that is heard often but may not be understood. Internal controls are processes and procedures, or checks and balances, that are put into place at the library. The board sets the standards and official policies that provide the environment for internal controls, but the responsibility for putting these controls into place rests with management in the day-to-day operations of the library. Policies are the particular guideline or goal that a board wants to achieve. The processes and procedures are the actions that are necessary to be in alignment with the guideline or to achieve the goal that the board set. The terms internal control and control are used interchangeably. Internal controls are needed in order to safeguard assets, achieve proper conduct of business, and to ensure financial integrity. Safeguarding of assets includes controls that help prevent and detect fraudulent activities. Examples of controls to safeguard assets would be the monthly bank reconciliations and the review of those by the next higher level of library management. Controls that achieve proper conduct of business help ensure that the library stays in compliance with laws and regulations, safeguards information of employees and patrons, and operates ethically and efficiently. An example of a control to achieve proper conduct of business would be policies and procedures to protect personally identifiable information. Financial integrity is ensured by having many internal controls throughout the entire financial and accounting process. Examples of internal controls related to financial integrity include disbursement and receipts policies and procedures. Setting policies and procedures is the first step in having strong internal controls, but these controls must be implemented, maintained, and monitored on a day-to-day basis in order to be effective. None of us want fraud or even mistakes to occur that will need to be investigated, but rather we want to prevent these types of things from happening. So, by being transparent to employees and letting them know that there are processes in place that are monitored is another key to the internal control process and key to reducing risk. Employee handbooks and whistleblower policies are a few of these transparency actions that can be taken. Lastly, who is responsible for the internal controls of the library? That responsibility rests with management of the library, which is exercised under the oversight of the board. It is management's responsibility to put controls in place to prevent and detect irregularities. Management should not rely on their external auditors to detect fraud. The independent auditors are not a part of the internal controls of the library. The vast majority of fraud is detected by persons within the organization, not the external auditors. There will always be inherent limitations to the most sound internal controls. Certain inherent limitations need to be considered when implementing or analyzing a library's internal controls to determine the amount of risk they are willing to expose the library to. Human error is inevitable. However, certain processes can be put into place that reduce or minimize the risks. Every time a person touches a transaction, it is susceptible to mistakes being made. For example, if payroll is calculated in an Excel spreadsheet and then that information is entered by hand into the accounting system, it is more susceptible to human error than payroll that is processed by a payroll module that automatically posts the entries. Even though errors are inevitable, they can be minimized by proper internal controls. Deliberate circumvention is when an employee bypasses rules that are set in place. Deliberate circumvention isn't always because an employee is out to commit fraud, but often an employee just doesn't want to take the time or put in the work that is required to play by the rules. However, with strong internal controls, deliberate circumvention can be minimized. Effective internal controls can require multiple levels of personnel to be involved in various processes and/or sophisticated hardware and software. So there's a cost to putting internal controls in place. Therefore, management needs to perform a cost-benefit analysis to determine if the cost of additional controls is worth the benefit that's obtained. The size and resources of a library should be taken into consideration when implementing internal controls. Large libraries generally have greater resources which can be used to develop and implement more effective internal controls, but they also have a higher monetary risk. Small libraries may not have the resources to implement strong internal controls, but the risks of loss are also smaller. However, libraries with limited resources can always implement controls to minimize those risks. For example, rather than hiring a second employee, a small library may opt to have a board member perform certain review functions. One of the biggest reasons internal controls are put into place is to help deter or prevent fraud or embezzlement. There are many common indicators of fraud and embezzlement, but strong internal controls can help minimize the risk of it occurring. Please remember, just because an employee matches one of these indicators, it does not mean that he or she has committed fraud. There are red flags, and we encourage management to evaluate their employees with skepticism and recommend further investigation if indicators exist. All too often, we hear about fraud or embezzlement, and the next statement we hear is that it was performed by someone who management or coworkers would have never thought would do that. This list is not all-inclusive, but there are a few of the most common indicators. Chapter 10 of the Public Library Financial Management Guide has a more extensive list, but again, that list is not all-inclusive. Fraudsters are always thinking up new schemes, and as electronics are getting more sophisticated, it is becoming harder and harder to detect. A common red flag is when an employee's lifestyle appears inconsistent with their income level. If it makes you scratch your head wondering how they could afford that car, house, or vacation, then it deserves further investigation. Possibly the spouse has a good paying job, or the employee received an inheritance, or possibly an embezzlement has occurred. Another red flag would be when an employee is experiencing personal financial difficulties. Employees may borrow a small amount of money from petty cash or from a daily deposit with the expectation that they will pay it back when payday rolls around. Further investigation may show that there are larger deposits around payday or that checks received aren't being deposited right away, but rather being held back until the payback occurs. If an employee is overly sensitive to their workspace and reluctant to let others share their duties, that may be a red flag. That person may be reluctant to take vacations, or they may be fearful of someone finding checks that are waiting to be deposited at a later date, or that there is a duplicate set of receipt books where cash and checks are recorded in a receipt log, but that log may be duplicated without some cash. This is another hiccup. All right, here we go. Is an employee overly sensitive to their workspace and reluctant to let others share their duties, or possibly reluctant to take vacations? This is a red flag that the employee is fearful of someone finding checks that are waiting to be deposited at a later date, as mentioned earlier, or that there is a duplicate set of receipt books where cash and checks are recorded on a receipt log, but that log is duplicated without some of the cash prior to turning it in to the treasurer or accountant. Or possibly the employee is hiding correspondence that has been received from federal or state entities, which is questioning payroll taxes, which could be an indicator of a fictitious employee. Fraud has been discovered involving employees replicating bank statements and changing balances or deposit and withdrawal amounts. The majority of employees now have access to software that allows editing of scanned or downloaded documents, which allows for manipulation to occur. Manipulated bank statements will sometimes have typos or spelling errors in them. Something else to look at on a bank statement is the font. Does the font look uniform or normal? Although editing software is remarkably good, it doesn't always produce the exact style or size of font that the original bank statement had. If something looks odd, further investigation is recommended. While these are just a few of the common indicators of potential fraud or embezzlement, internal controls policies and procedures can be implemented to reduce the risk. For example, multiple layers of employees being involved in the cash receipts process so that no one person has access to both the physical custody of cash and the accounting system. This can minimize an embezzlement scheme that is creating a lifestyle beyond an employee's income level. Also, management may require that only the original bank statements will accompany the monthly bank reconciliation, where a person outside of the bank reconciliation process opens the bank statement and initials and dates the statement prior to giving it to an employee who reconciles and has access to the general ledger. Recommended policies are found throughout the Financial Management Guide as they relate to the topic of this specific chapter. However, Chapter 10 touches on other related internal control policies that are highly recommended. Appendix 3 has several good examples that can be used for your library. Although there are more recommended policies for strong internal controls, we'll touch on just a few. A purchasing policy specifies dollar amount thresholds, who is responsible for purchasing, what methods are to be used, such as credit card usage, check request, purchases on account, and the like, as well as approval authority. A fraud risk management policy may involve the board's mandate for management to actively search for fraudulent transactions, but should also inform management and employees as to the nature of fraud and the actions expected to be taken if fraud is suspected, as well as a statement that fraud will not be tolerated and instructions for reporting fraud within the chain of command. An anti-theft policy is simply a policy that states that employees shall not steal. Interestingly enough, studies have proven that entities with this statement in their employee handbooks have less employee fraud than those who don't. This could be part of the fraud risk management policy. Every library should have a whistleblower protection policy so that employees feel safe from retaliation if they report their suspicion of fraud. A personally identifiable information policy, also referred to as PII, pertains to the protection of both employee and patron information. PII is information that can be used on its own or combined with other information to identify, trace, contact, or locate a person. PII can be in either an electronic or a physical form. Libraries and all entities have a moral and legal responsibility to protect this information. Monetary losses and legal ramifications can be extraordinary if the library experiences a breach of PII. Chapter 10 of the Library of Michigan's Financial Management Guide contains more information on what should be included in the PII policy.